The market may not be able to make a distinction between high quality consumer names and whether to buy or sell them. But the last 1 year, there has been a distinct distinction made from the financial space. The question to somebody who tracks this space as closely as the back of his hand is what happens next over the course of the next 12 to 24 odd months. Anil Agarwal of Morgan Stanley is the guest, and he joins us right now. Anil, so good having you. Thanks so much for joining in. Neeraj here. Good afternoon or good evening to you, as the case may be.
Hey, Neeraj, thanks for having me here.
Pleasure is ours.
Thank you.
What's your sense, Anil? The last 2 or 3 odd weeks seem to suggest that there is some bit of capital or / funding going into some of the troubled spaces, be it in the financial space or be it companies which have borrowed heavily and are getting that funding. Is this a sign of resolution to come, or is this very, very company specific?
I would think that this is very company specific, because I guess the investors, if you look at them, the names which are being talked about, I don't know whether the deals actually come through or not in financials, but the names which are being talked about are more long-term investors. So maybe they are taking the view that given where the valuations are right now, some of these names can be very attractive. They take a 5, 6, 7 year view. I think that's what is happening here. So my view, at least in the financial space, would be, I think it's very, very company specific.
Mm-hmm. No, but this whole, I mean, if not just in the financial space, but some of the other troubled assets getting the money as well, SBI giving out the commentary that they'll see some 3 large resolutions happening too. Do you get a sense that in terms of recoveries for the banking space at large, things might improve over the course of the next 2 or 3 quarters?
So we have been baking in some recoveries coming through, Neeraj. Obviously, you have a couple of pretty large cases which have been going through the bankruptcy court, where the resolutions have not happened for quite a few quarters right now. So I think we and most of the consensus, the street is expecting those resolutions to come through. Over and above that, obviously the concern right now is that quite a few other large groups or semi-large groups are facing issues from a liquidity perspective. So if they can raise capital, or they can basically raise liquidity, obviously that reduces some stress which is building up, because the whole idea was that India is coming out of an NPA cycle at the beginning of this year. That was the view that markets generally had. There has been a bit of a hiccup on that. So if quite a few of these corporates can raise equity or liquidity, I think we can go back to that path of expectation of lower credit costs as we move into next year. But we need to wait and watch. I mean, right now it's more news flow, so you need to actually see a number of these financial companies, etc., to actually get the liquidity or capital.
Anil, good afternoon. Let's talk a little bit more about the kind of commentary that we've been getting this quarter from the corporate-facing banks, as well as, the smaller banks, cautiously optimistic, as well as sounding fairly optimistic on the corporate, finance side. Do you feel that, you should probably buy into these, comments that have been coming in with regards to a turnaround that is on the anvil, or you still feel you tread with caution despite the commentary? We should need to see an actual proof of that and then probably get optimistic ourselves.
So our view has been that there's sort of a lack of credit flow to lower rated credit corporates, which has been going on. So if you look at anybody who's BB and below, or even BBB and below, right now is struggling to get liquidity. Because a large chunk of the lenders, be it stressed banks or non-banks or housing finance companies, do not have the liquidity to actually lend there. I don't think that is changing in a hurry. So that part will likely continue. So as a result of which, our view would be that the pace of new bad loan formation is going to be much lower than what we have seen in the last few quarters. But I don't think it's going to be zero, or it's anywhere close to be zero. So credit costs will likely remain elevated. But in that backdrop, what's happening is that the good banks, be it retail lenders or some of the large corporate lenders, I mean, they are making, they are doing very, very well. They're gaining market share, be it in loans, in deposits. If you look at all the steps which have been taken by the policymakers or the regulator, be it increase in liquidity in the system, or cutting risk weights on unsecured loans, or cutting tax rates, I mean, these few banks are actually benefiting a lot. So our view would be that I'm not putting them into retail or non-retail, just the big lenders who are kind of unstressed books or coming out of those stressed exposures, I think the environment for them looks fantastic in my view. Our view is that the underlying earnings progression for these banks will be upwards of 20% for the next 2 to 3 years.
Yeah, but that's...
And hence the point that I think Neeraj was making earlier, which is the quality will just keep doing very, very well.
You know, so that's a given, and that's precisely the reason why they attract the kind of premium that they do in terms of price to book. You name an ICICI bank now, you name an HDFC bank, but just, you know, let me ask you another question. When we're looking at private sector banks versus PSUs, PSUs has been the long forgotten space, though the commentary now has started to, you know, spur up there as well. The government is pushing liquidity. They're recapitalizing these banks. They're trying to make sure that they turn the page. Do you see a first mover's advantage to try and read into the PSU turnaround story, or that's for another time and that's, you know, something that will come about probably a few quarters down the line?
So in hindsight, we will look back at this and say that, okay, this was the time to buy the PSU banks. My view is that given where we are in the credit cycle right now, we don't have any overweight on any of the PSU banks right now. We would rather stick with the private lenders because our view is that the underlying system, while it's improving, it's healing gradually, if I can use that term. We expect loan growth in the system to remain relatively benign, high single digits to about 10 to 11% for the next couple of years. Credit costs to remain elevated, as I said, lower than earlier. In that backdrop, I would just stick to the top quality guys. Now, within that, you can have a risk spectrum. So you can have somebody who's very expensive or has not been hit at all. You can say that, okay, I'll rather buy a more riskier proposition where credit cost is going to come down. But sorry, I can't take names. That's the problem I'm grappling with. But state-owned banks, we don't have any buys right now. I would rather buy the private banks, the big private banks, not the smaller ones.
Okay. Anil, you also highlighted that liquidity for lower rated corporates has been an issue. And of course, not naming any banks here, but looking at Yes Bank's number, the BB and below book, 60% slippages came from that pocket. So do you think going ahead, once again, liquidity will continue to be a problem for these lower rated corporates? And going ahead in subsequent quarters, can we expect more of NPAs then from BB and below rated books?
So in our numbers, we treat BB and below as impaired because unless economy comes out strongly, I think it's just like what was single A 5 years back, a lot of them have actually turned BB or worse. So unless economy comes out strongly, some of these BB exposures will turn bad. So we treat BB and below as impaired. So we look at coverage ratios and the whole thing for all the banks, not just a particular bank. Because again, unless credit flow improves to that sector, it's unlikely that we don't see high elevated impaired loan formation or bad loan formation out of that BB portfolio. So what's happening here is that the lenders who are lending to that particular space are themselves struggling with raising liquidity. So they are trying to contract the balance sheet. So they're not lending to the BB or BBB and below. And the big lenders, even the guys who got impacted by NPLs in the previous cycle, incrementally are not growing the BBB book. I mean, you look at the largest lenders, and for them in the corporate side, 90 to 95% of all the incremental originations are A and above, A minus and above. So who lends to the BBB book? And unless that comes in, unless the flow of liquidity to them, credit to that sector improves, whether it's an SME, whether it's real estate, whether it's a non-bank, the stress will be there. I mean, not everybody will default, but the stress in that segment will be there.
You also spoke about the credit growth, and that's been a concern, I think, for the longest time now. What is your assessment with regard to revival of credit growth back in India?
So, I mean, within credit growth, retail is doing very well. We remain quite confident of underlying retail growth and asset quality in that segment. Outside of that, as I said, the struggling part, which is BBB and below, I think credit availability will remain very tight. When we put that all together, you ultimately end up with, say, around, I think for this year, we are around 9.5. Next year, we are probably at 10 to 11% overall credit growth in the system, which is banks, NBFCs, et cetera, combined. I doubt it'll be much higher than that, because what's also happening is you need to take into account what's happening at the deposit side of things. The deposit growth in India is running at about 9.5%. Loan to deposit ratios generally in the system is quite high. So for the system as a whole, loan to deposit ratios is in mid 70s. But the state-owned banks are at 65, 66, the private banks are at 84, 85. So private banks cannot really grow much more than the deposit growth. So unless state-owned banks really start growing aggressively, much more than 10%, I think credit growth in the system will remain relatively muted. So for the system to actually come out of slowdown in credit growth and for the credit to flow into, like, across the spectrum, you need state-owned banks to start lending reasonably, or rather at a much faster pace than they are right now.
Anil, just one last question from my end.
Because right now, if I'm a bank, I lend to A- and above, and
Yeah.
I can make a high ROE.
Okay.
Sorry.
Got that. No, I was just, one final question from my end on this. Is the pace of recoveries, and we're talking about NCLT resolutions out here, and how much of prominence are we going to give to that with regards to the next few quarters and the kind of resolutions that most of these banks will see?
Sorry, the voice broke. So sorry, I didn't get the question. Can you repeat the question?
I was asking you about the pace of resolutions that we are seeing currently. Obviously, when we started off with the IBC, we saw in the resolutions happening at a much more swifter pace. That seems to have slackened a bit more at this point in time. Do you see the pace of resolutions picking up, and therefore that auguring well for the banks?
I mean, that's been from our numbers perspective, at least the disappointment has been that resolutions have been much slower and fewer. So in our numbers, we are building in some pickup in resolutions, but obviously the current 2 or 3 cases which are kind of stuck in the process, they need to be sorted out. Some case laws need to be set, and then hopefully in the future we'll get faster resolutions. But yeah, resolutions across the board have been much, much slower than what anybody was expecting after the IBC was set up.
Anil, would you sense that some of these high quality lenders and the large lenders that you mentioned about, because they are able to pick and choose what they want to do in terms of lending, in that 20% growth, earnings growth and whatever loan growth that you might be factoring in, it will be accompanied by higher NIMs and therefore higher ROEs and therefore even higher multiples than what they enjoy right now?
I think so, yes. So what's happening here is that from a net interest margin perspective, margins are broadly flat, despite the fact that rates are coming down. In a low rate environment, generally for banks with high CASA ratios, margins should trend down, but margins are relatively holding up, which is a great thing. Which just shows the pricing power that these banks have. Second thing which is happening is that the whole digitization in India is actually helping these big banks a lot. So if you look at the cost to income ratios or cost to asset ratios for the Indian banks, the good banks, they're coming down at a pretty furious pace. So you have stable margins, stable revenues, costs coming down, as a result of which the underlying return on assets or ROEs for these banks is actually improving. And now you also have another added benefit of lower tax rates. If you look at most of these banks, the big banks, with the exception of I think 1 or 2, valuations are still at long-term averages, which I don't think is the case in relatively quality in other sectors. So if these guys keep reporting the numbers that we expect them to, I mean, at worst you have compounding. So if these things compound earnings at 20-22%, you get that return, plus you can potentially have re-rating. So I think the story, I mean, again, these stocks have outperformed the rest of the sector quite meaningfully. But I think the outperformance over the next couple of years can still be massive. Like our target prices between the good guys and the weak guys is just, there's a dramatic divergence. So I think there's still a massive outperformance to be had by buying the large guys.
We reported quite extensively on the note that you put out on one of the large private lenders, Anil, I must say that. One final question, and that is on the kind of money that is chasing some of the quality names. And if Bajaj Finance's QIP is a case in point, would you reckon that money flow towards these expensive names would continue for all of the reasons that we've just spoken about? It will not see the valuations, but rather see the quality, because, you know, in India right now, the last 1 week, there is a massive conversation about how quality seems to be at a bubble territory.
In financials, I mean, again, a couple of names, valuations are high, but given the kind of earnings growth they are reporting, I don't think stocks are in a bubble territory. Otherwise, we won't be saying buy the big banks. In fact, most of the big guys we have an overweight on and very punchy overweights on. I don't think the valuations for the big guys are in bubble territory.
Okay, well, that's good to know. And
because I mean, if you're growing earnings at this pace, there's nothing else in the world. Yeah, there's nothing else in the world of financials which is giving you this kind of earnings growth.